and JP Morgan is right and you do a negative print in the first quarter, we have to start talking about going back into recession? The market's going to be okay with that?
Well, no. Well, I think that the market, there'll be periods of volatility, translate that to selling off at certain points in time, and that'll be opportunities to get back in, because I think you're on the cusp with the vaccine again of a synchronized global economic expansion that we haven't seen, as opposed to the global synchronized sell-off in the economy as the recession. So there will be some tough sledding. We're going to see the pictures more and more. But the memory of the investor is that, hey, if we sold in March, it was the wrong thing to do. Look at the recovery. We feel pretty foolish. So I don't think you test the lows. Could we go down 5 or 10%? Without question. But you don't trigger your tax bill by selling companies that continue to be winners. And I think it's technology that's going to win. Technology is not PCs and laptops. Technology is in everything we do, from cars, you just name it, smart cities, smart homes. So I'm comfortable, but I can sit through the volatility.
So, Jenny, if you're looking a year out, let's say your horizon's a year, and the way that you view the market and the way that you invest for your clients, why wouldn't you want to go all in, so to speak, on the Belsky plan of double upgrading industrials, adding there, finally thinking that financials across the spectrum are going to have a good run of it, and go in there, and other areas of the reopen and the cyclical trade?
I think once you've set aside whatever cash, whatever safety net you need to make sure that you can get through the next year, no matter what happens, I think you do go all in on the Belsky plan or something pretty close to like that. I think that's what leads. I think the sectors and the companies that he's referring to, they are not up 25% this year. They're not up 12%. They're still kind of in the dumps, and their valuations are reasonable, so you have this moat of safety built around it. So I think you do go with the Belsky plan. And just circling back to one other thing, getting us through this dark period where there are 200,000 cases a day, it is different right now than March. And Steve made a super important point, which is the investor memory. Everybody knows that it was stupid to sell between March 18th and March 23rd, and that you would have been better off buying. So I think that that keeps a floor on whatever fear ekes its way in. I also think the fear is going to be a lot less. I mean, I'm not scared the way I was in March.
I mean, you know, hindsight's 20/20.
Yeah, but it's also useful. But we learn from that, you know, and if we get it again really quickly, we're going to learn from that. It's just not as scary, right? And we've all also learned over the past 8 months how to continue to live in a much more robust way than we were doing in March and April when everybody was scared and shut down.
Your point's well taken. I'll give you that. It certainly is. You are buying a stock that is reflective of your point of view as well. Fortress Transportation and Infrastructure. Can you tell us about that? It has a nice yield.
This is really interesting. So the bulk of their business is in aircraft leasing and aircraft engine leasing, and it's complicated and it's messy. It has a really good yield. It's a company where you can't look at the earnings. You need to look at the funds available for distribution, and so it's really cash flow oriented. But it's neat because you can look at it and say, like, whoa, their business was impacted negatively from COVID. But, and I think this is what you want to do as you invest right now, you want to say, was the negative impact by COVID permanent or episodic? And in the case of Fortress Transportation and Infrastructure, it was episodic. So as the airline industry crunched down, right, obviously the leasing came into, and their earnings were really impacted. But going forward, not only is that likely to return to normal, but as the airlines are cash crunched, they're much less likely to buy aircrafts, to repair their engines, to buy new engines. They're much more likely to lease. And it's the same as when you buy a car, right? And you lease a car or buy a car. You kick the big cash outflow down the road by leasing. That's what they're going to do. So not only did they survive this period, and this was the ultimate test of the strength of that business, but they've got a setup for very positive revenues and cash flow ahead.
I've seen
really excited about that and love the yield.
Yeah, that's a nice move in the stock too, as we're having that conversation.